Hello, welcome back to Intermediate Corporate Finance, lecture note 7, right? Today we're going to talk about equity side of valuation, which is dividend discount model and the free cash flow to equity method, okay? Now, let me start with the timers on because I checked out your midterm review of my class, right? Class evaluation. Welcome. Thank you for your nice comments. And then a lot of you said you like my lecture. Thank you very much. And one negative side of it was that negative comment was that I am too talkative. Okay. So I was going overtime one time or two times, right? So this time I'm trying to make it more succinct than not, right? So timer is on. Every 15 minutes my dog will be barking, rah, 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 and I will stop somehow, okay? And then let's see how it goes. So all right, two channels of value. What was that? Well, first of all, value is not observable while price is observable. The value is something that you estimate, right? But what affects the value, right? Cash flow and discount rate, or the same thing, cash flow and the risk of the cash flow, okay? So discount rate, we've gone through. Cash flow is something we are going to touch on from now on, okay? And then the value, mathematical formula looks like that, the present value formula, right? Expected future cash flow, discounted at relevant cost of capital. Remember the time point, okay? 0. Standing here right now, you are trying to estimate the fair value of your company, right? And then the cash flow, the expected cash flow is the cash flow that will happen in the future. The cash flow that already happened, that is already in your pocket, nothing to value about it. This is, you know, your cash received already. Say bye-bye, okay? Gone thing is gone. Value is about the future. So that's one thing to be careful about. We will learn how to compute cash flows in the past to understand how the company performed in the past, and you may extrapolate the growth trajectory into the future. And we will learn how to compute the cash flows in the future. It is pretty much the same as how you compute the cash flows in the past, but it is projected based on a lot of assumptions about the growth, reinvestment, and profitability and efficiency kind of things in the future. So, cash flow, understanding it, analyzing it, okay, looking in the past, that's one thing. And then how will it happen in the future, okay? That's another, right? So going into the future, because we are valuing, okay, you're using the expected future cash flows, right? This part will need a lot of assumptions and information that you don't have, okay? Sometimes you'll have to be flexible and you use your imagination sometimes, but you have to be internally consistent. Cash flow to the investors, right? Well, cash flows to the companies. How many claimants do you have? 3 different claimants, right? Claim holders. The first, the most important claim holders for your company's cash flow is the government, right? You don't want to piss off your government, right? If you don't pay taxes to the government, all the big troubles happen to you. Okay, 세무조사 한번 뜨면은, right? Once the IRS come to your company, you'll essentially have to stop doing your day-to-day business. You're gone. Okay. So you first have to pay taxes and say bye-bye to the government, right? Then 2 claimants to your cash flow still remains there. One is debt investor and the other is equity investors, right? And these 2 guys, we call them firm investors, debt and equity. You know that, right? Cash flow is the one that comes to the investors by doing day-to-day business after paying tax and after reinvesting for business expansion. If the cash flow is to the equity holders only, it should be after repaying debt to the creditors. Creditors means debt holders, right? Debt investors, and borrowing from them, right? Now, I'm trying to simplify those arguments as much as possible, because after learning about accounting and finance, right, a lot of students feel they are helpless and hopeless, perhaps because we've been teaching too much of a detailed technical stuff, too much, okay, so much so that we are losing the main points, okay, main points. How to estimate the cash flow itself, right, is important, whereas the detail about it, okay, is something that you can learn in advanced courses. Why do I care about it? Because there are a lot of people, you guys, who wants to do some venture financing later on. I want to create my own venture instead of working for Samsung. I had several people, students, right, talking to me like that. So doing your own business, right? That's great, creating your own venture. But they say that the biggest trouble is how to do financial projection, right? Revenue projections and cash flow projections, all these kind of things are so much trouble. I don't know how to do it in the first place, they say, okay? But relax, right? Sit back and relax. Those things are something that should come intuitively once you understand this basic concept naturally, okay? I don't want to divert you too much into the technical detail of it, right? I'm not educating you guys for CPA exam, okay? So that's one thing to tell you. Now, measuring cash flows, okay? Measuring cash flows. Well, cash flow can be measured for either equity holders or for both debt holders and equity holders. You see the arrows going up and down, right? So the red box, that's what we're going to talk about in this class, right? This week, the cash flow just to equity investors. And next week, we're going to talk about cash flows going to the debt holders and equity holders, okay? Firm cash flow, free cash flow to the firm. So first thing this week, right? The equity holders cash flow, the most classical one is dividend, okay? So we're going to talk about dividend discount model, okay? Either you call it dividend or repurchases, it doesn't matter. It should be the same thing, okay? The cash spent out for the shareholders. The other form of equity holders in cash flow is something called free cash flow to equities, right? FCFE, okay? Just to throw you a formula first, this starts from the net income, and then you subtract out investment amounts, which is your capital expenditure, and then change in net working capital or non-cash working capital. Well, whether you call it this way or that way does not matter. It's all about working capital. And then for capital expenditures, you have to adjust for the depreciation amount in the cash flow statement. And then you're going to talk about the detail of these items later on. And then once you subtract out those investment amounts, you have to subtract out the cash flow to the debt holders, right? For example, principal repayment and new debt issuance, right? New debt issuance. That's a cash available to shareholders. That's why. Okay. All right. So next item that we're going to talk about next week, the free cash flow to firm. That is, well, it starts from operating income. Why is that the case? Because in FCFE, we started with net income, where we already paid these interest expense to the debt holders, right? So debt holders, we said bye-bye. Moreover, we also subtracted the principal repayment, right, in FCFE, okay, over here and over here, right? It's already subtracting the cash flow to debt holders. But here in FCFF, debt holders are also one of the major investors that we care about, okay, in the firm as a whole, right? So for that part, we start with the operating income, but that's EBIT, right? Earnings before interest and tax. But we have to say goodbye to the government first, our most important claimants to the cash flow, right? So 1 minus tax rate, that's done. If we look at the FCFE, did we say bye-bye to the government? Yes. By how? By starting with net income. This is profit after tax, right? So we already said bye-bye to the government. But in FCFF, we start with operating income. That's why we had to manually subtract those tax to the government if it should be paid by this based on this account operating income. Now after that, what do we do? Subtract the investments. Okay, the investments, it's the same thing over here. Okay, those investments, capital expenditure net of depreciation and amortization, and change in non-cash working capital. Okay, they are the same thing. Okay, we're gonna go through that part later. What we mean by each. Now roadmap, equity valuation. We're gonna talk about it this week, especially dividend discount model. First half of this class, and second half it will be about FCFE model. Next week we're going to talk about FCFF, which will be discounting at weighted average cost of capital. Adjusted present value model, well, we'll have to skip it in this semester. Now, dividend. Okay, this is the most classical form of cash flow to equity holders. Okay, most classical form of cash flow to equity holders. Well, for that purpose, we first need to go through the income statement of any companies, right? So the top line is revenues. Bottom line is net income. Okay, we will start from the bottom line. Start with the bottom line. Okay, but for that part, we need to refresh our memories about the income statement a little bit. So starting from revenues, we typically subtract cost of goods sold and SG&A, right? Sales, general, and administrative cost. Then we get earnings before interest and tax, which is called EBIT or operating income, whichever way you call it, doesn't matter. And there, this is the income that you can get by doing day-to-day business, your real business, right? If you are semiconductor manufacturer, this has to be your income coming from semiconductor manufacturing business, right? Not from some special gains or losses coming from your foreign exchange gains or losses, evaluation of your foreign exchange exposures and things like that. Those are non-operating incomes and expenses. But what we care about is your day-to-day business, okay? Day-to-day business. And then that's EBIT, and then we subtract interest expense, right? Because this is one of the non-operating expense items, right? But interest expense is an important one, so that I separately wrote it down from non-operating expense, right? Separate it out. Because interest expense is about raising capital, okay? Serving your debt holders, right? Whereas non-operating expenses, it's related to all different kind of things. Non-operating income is also there, right? Those things, typically in my class or finance class, we don't care about it, okay? Our job is to best understand your cash flows coming from your operations and coming from your true business, day-to-day business. Okay, non-operating income and expenses, those things comes and goes, right? So that's why. Then what do we get? We get to profit before tax, right? And then finally, you pay tax to Uncle Sam or Uncle who is this Sejongdaewang, right? or you know, a government, okay, and say bye bye. Don't bother me. I did my duty as a nice corporate citizen, right? Paying tax. Finally, you get to net income. Now, starting from net income, dividend discount model starts, right? Why? Starting from net income, this is a time to do profit sharing, okay? So we get to the equity investors. Already, my dog is barking. So, 1 minute left. Okay. Dividend, right? We pay out of this net income, and the leftover part is called something called retention, okay, retaining. And those retained income, okay, retained part is reinvested to your business. Make sense? So after getting net income, either you share profit with the equity investors or reinvest for future business. So why do you reinvest? Well, to make a growth, to grow it, grow your business. If you are totally dedicated to growth, then you don't pay dividend and the 100% is reinvested. On the other hand, if your company has low growth potential, pay out dividend as much as possible and say, you know, boom bye all the way down and then say bye bye. Okay, that's also a good option. Okay, so that's that. Let me come back.